Welcome back to the ProTicker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. We've got a stack of articles here from MarketWatch, The Wall Street Journal, and Bloomberg, all dissecting the U.S.'s new wave of tariffs on goods from Mexico, Canada, and China. Now, you're probably thinking, how on earth is this going to affect me? That was say. Well, that's exactly what we're here to unpack today.
And it's a complex question, because these tariffs aren't just abstract figures on a balance sheet. They have the potential to ripple through the economy, impacting everything from the price of groceries to the stability of the global market.
Right, and speaking of groceries, a MarketWatch article, Americans are racing to prep for tariffs, but many aren't ready, especially this group, really highlights how this could hit our wallets. It estimates the average household could see their expenses jump by nearly $1,000, maybe even over $1,200 a year.
And that's not even the whole picture. This comes at a time when a lot of folks are already struggling with rising costs. The article points out that personal savings rates are down, credit card debt is up, and we're all still feeling the aftershocks of that inflation spike back in 2021, 2022.
It's like we're getting hit from all sides. But what really struck me in the article was how these tariffs could disproportionately affect lower-income households.
Exactly. And the reason for that is simple. Lower-income families spend a larger percentage of their income on essentials, food, clothing, basic necessities. The very items that are likely to see the biggest price hikes due to these tariffs. They have less wiggle room in their budgets to absorb these added costs.
And the article doesn't sugarcoat it either. It mentions rising delinquency rates on credit cards and car loans, suggesting some families could be pushed to the financial brink.
This potential financial strain is definitely a major concern. It raises the question of whether these tariffs could actually deepen existing inequalities, widening the gap between the haves and have-nots.
It's a sobering thought for sure. And it's not just an American problem, is it? These tariffs have ignited what some are calling a potential global trade war.
Precisely. The Wall Street Journal has an article, China Sets Strong Growth Target as It Hits Back at U.S. Tariffs, which details China's response. They're not taking this lying down.
So what's their strategy?
Well, they're hitting back with retaliatory tariffs of their own, strategically aimed at U.S. goods that will put pressure on American farmers. Think soybeans, pork beef. These are major exports for the U.S., and China is a huge market.
It's classic tit for tat, like a high-stakes game of chess with potentially devastating consequences.
Absolutely. This situation creates a huge amount of uncertainty for businesses on both sides of the Pacific. Imagine you're a farmer in Iowa who depends on exporting soybeans to China. Suddenly, your main buyer is out of the picture. That's a huge blow, and it's hard to plan for the future when the rules of the game keep changing.
The Wall Street Journal published another article, Tariff War Risks Sinking World into New Great Depression, International Chamber of Commerce warns, that really drives home the potential global impact.
That title is certainly attention-grabbing, and it's a stark warning from a respected organization. The International Chamber of Commerce is comparing this situation to the trade war of the 1930s, which many economists believe contributed to the Great Depression. They're essentially saying that if we don't tread carefully, history could repeat itself.
And it's not just speculation. We're already seeing these ripple effects play out. Take Canada, for instance. Bloomberg has an article, Toronto home sales slump 29% as economic uncertainty ramps up, that reports a significant drop in home sales, partly attributed to the trade tensions with the U.S.
This is a perfect illustration of how interconnected the global economy truly is. Even if you're not directly involved in international trade events on the other side of the world, can impact your local housing market, your job security, even the prices you pay at the grocery store. It's all intertwined. And while all this is unfolding, there's another interesting dynamic playing out in the investment world. We're seeing a surge in interest in what some are calling degen trading.
Degen trading. That sounds a little intense. What exactly does that entail?
Well, think high-risk, high-reward bets. Options trading, meme stocks, event contracts. These are all part of the degen playbook.
Okay, break that down for me. What are event contracts?
Yeah.
And what makes this style of trading degen?
Let's start with event contracts. Essentially, it's betting on whether a specific event will or won't happen. MarketWatch published an article titled, Is Investing Becoming More Like Gambling? Yes or No? Betting on the new retail trading craze that dives into this. They give an example of Kalshi, a platform where you can bet on things like fluctuations in egg prices, the outcome of elections, even whether someone will receive a presidential pardon.
So it's like a prediction market.
Exactly. And the degen part comes from the high-risk nature of these trades. Degen is slang for degenerate, often used humorously to describe someone who's willing to gamble big, often defying traditional investment wisdom.
So are people feeling so squeezed by economic uncertainty that they're turning to these riskier bets out of desperation?
That's definitely one interpretation. The MarketWatch article suggests that millennials and Gen Z, particularly men, are increasingly feeling like the traditional paths to wealth are closed off to them. They see these high-risk bets as a potential shortcut, a way to get in the game, even if it means risking it all.
It's a bit of a nothing-to-lose mentality then.
That's a good way to put it. And this trend is amplified by the easy access to these types of trades. Platforms like Robinhood Interactive Brokers, even Coinbase, have made it incredibly easy for anyone with a smartphone to jump into these markets.
So it's a combination of economic anxiety, a desire for quick riches, and the accessibility of these trading platforms. Is this a recipe for disaster?
It certainly carries significant risks. The article highlights the danger of social media-fueled FOMO, fear of missing out, where people see others making quick profits and feel pressured to join in even if they don't fully understand the risks. It's a potent mix that could lead to significant financial losses for many.
It's almost like a cultural shift, this embrace of high-risk, high-reward trading.
And it's a shift worth examining closely. What does it say about our current economic climate and the anxieties of younger generations?
Now let's circle back to President Trump's comments on the tariffs. A MarketWatch article, Trump tells Congress tariffs will be a little disturbance. Why it's more than that, according to economists, points out a pretty stark contrast in viewpoints.
Yes. The article highlights this disconnect between the administration's perspective and the warnings of many economists. President Trump is downplaying the impact, calling it a little disturbance, while economists are forecasting much more significant consequences, even a possible recession.
So who should we believe?
I think it's less about believing one side or the other, and more about recognizing that there are multiple perspectives at play here. The administration is likely focused on the potential long-term benefits of reshaping trade deals and boosting domestic industries.
But the economists are concerned about the immediate and potentially devastating impacts on businesses and consumers.
Exactly, and those concerns are valid. We've already discussed the potential impact on household budgets and the ripple effects through the global economy.
So it's a balancing act between these competing priorities and perspectives. But how does this impact investors? We touched on the rise of de-churn trading, but what about traditional investments?
Well, the markets have been reacting to this uncertainty with some wild swings. A Bloomberg article, Traders See Wild S&P 500 Swings After Trump Address to Congress, describes the volatility we've been seeing.
So investors are essentially on a roller coaster trying to ride out the ups and downs.
In a way, yes. And MarketWatch published an article titled, What 125 Years of Data Says About Diversification and Investing at Record Highs, suggesting that diversification might be a good strategy in this uncertain market. But even with diversification, there's no guarantee of safety.
Right, it's hard to predict what will happen next when there are so many moving parts.
Exactly. And this brings up another important point. This MarketWatch article you mentioned also touches on how some investors are feeling pressured to take on more risk, not because they want to, but because they feel like they have to.
So while some are diversifying, others are feeling pushed into those DGN trades out of desperation.
That's the concern. If these tariffs do lead to a recession, as some economists are predicting, it's likely to widen the gap between those who can weather the storm and those who are already struggling.
It's a complex and concerning situation with potential consequences that extend far beyond just trade balances and economic indicators.
And it's a reminder that even though we're talking about global events and financial markets, the impact of these decisions is ultimately felt on a personal level by individuals and families trying to navigate their daily lives.
Speaking of global events, we've focused a lot on the U.S. and China. But these tariffs are impacting other regions as well, right?
Absolutely. We talked about the slumping home sales in Toronto, but there are other, perhaps less obvious ways this is playing out globally. For example, the Wall Street Journal published an article called Eurozone Labor Market Stays Resilient Despite Weak Economy.
That sounds counterintuitive.
Yeah.
How can the job market be strong if the economy is weak?
That's the interesting part. The article mentions record low unemployment rates in the Eurozone, even though they're facing economic headwinds. It suggests that there are factors at play beyond just the U.S. trade war.
So even though the Eurozone isn't directly targeted by these U.S. tariffs, they're still feeling the effects, just in different ways.
Precisely. It's a complex web of interconnected factors, and it's hard to isolate the impact of any one event. But it's worth noting that a weakening U.S. dollar, as mentioned in a Bloomberg article, USD hits 3-month low with losses stark against EUR. could be playing a role here.
How so?
Well, a weaker U.S. dollar makes European goods more competitive on the global market. It can also impact investment flows and even tourism patterns. So while the U.S. is focused on its trade battles, other regions are experiencing their own economic shifts and adjustments.
It's like a giant game of economic Jenga, where one move can have unintended consequences across the whole board. And speaking of unintended consequences, one thing that's been on my mind is the potential long-term impact of these tariffs. What happens after the dust settles?
That's a crucial question and one that deserves more attention. Are these tariffs a temporary measure, a negotiating tactic, or are they a sign of a more permanent shift toward protectionism, if it's the latter? What are the implications for global cooperation and economic growth?
A MarketWatch article. Microsoft's stock is at its lowest level in over a year. Why the sell-off may be overdone. Briefly mentions concerns about Microsoft's capital spending plans, which include a significant investment in data centers for AI development. Could these tariffs stifle innovation?
It's certainly possible. If businesses are facing increased costs and uncertainty due to tariffs, they may be more hesitant to invest in research and development, new technologies, and expansion. That could have a ripple effect, slowing down innovation and potentially hindering long-term economic growth.
And what about the broader impact on global cooperation? The International Chamber of Commerce warning about a potential Depression-era scenario is pretty alarming.
Absolutely. These tariffs could erode trust between nations, making it more difficult to address shared challenges like climate change, pandemics, and global economic stability. We need to consider the potential consequences not just for today's economy, but for the future of international relations.
It seems like we're standing at a crossroads. The decisions made now could have a significant impact on the trajectory of the global economy and the geopolitical landscape for years to come.
And that's why it's crucial for everyone to stay informed, engage in thoughtful discussions, and consider the long-term implications of these actions. It's not just about understanding the economic data, but also the social, political, and technological forces that are shaping our world.
It feels like we've covered a lot of ground today. From the potential impact on household budgets, to the rise of risky investment trends, and the potential for a global economic shakeup.
And through it all, we've seen how interconnected these issues truly are. What happens in one corner of the world can quickly ripple outwards, affecting businesses, consumers, and investors across the globe.
It's a lot to digest. But as you said, knowledge is power. The more informed we are, the better equipped we'll be to navigate these turbulent times.
Exactly. And that's what we've aimed to do today. Provide you with a deeper understanding of the complex forces at play, and empower you to make informed decisions, both financially and in your everyday lives.
We'll be back tomorrow morning with new headlines from major financial magazines. Until then, stay curious, stay informed. And as always, thanks for tuning in to the ProTicker Podcast.